All right, guys, I'm going to go over how I use small accounts to compound my profits and build into larger accounts, and why it's so easy to do with options, because options give you leverage that other trading products don't give you. Futures is great, but it's static. Options have credit, they have debit, and they also have convexity, which amplifies returns as they get farther in the money. We can use all of these tools to create a systemized portfolio to actually build consistent wealth and not just take gambles on, every day of the week. That's fine with prop firms, but when you're trading your own money, you're going to feel some type of way of just making a one-sided bet and getting crushed if the market goes against you. But you shouldn't be getting crushed if you have a generalized idea of where the market's going. If you get caught off guard, that's one thing. But if you understand that the market has that beta drift and you're going long, you should be able to defend positions and roll positions out so that you can stay in profit. And most trades will end in profit. You can have an 80-90% win rate with selling options. So first, over here, we're going to look at the realities of a small account. Anything under 25,000 has pattern day trading rule. So if your account's under 25,000, you can't buy and sell a stock or an option at the same day without getting flagged pattern day trader. Futures, you can. You can also trade options on futures. So that's one workaround behind getting around the pattern day trading rule. If I trade a micro ES contract options, I can get in and out on the same day and not get flagged. But if I do SPY, I'll get flagged. If I do SPX, I'll get flagged. So that's one little trick that you can use when you have a small account. So that's an advantage. And the adjustment you need to make with your mind is that you need to consistently compound small increments of profits, because if you take these gambles and you get hit hard once, you can lose 60% of your account. But if you're only looking for little base hits, you're going to have a mindset of only taking quality and not really kind of gambling your money away. So when we look at the first phase of the building a small account from, I want to say 1,000 to 10,000, right? That's kind of where everyone starts. You could probably muster up 1,000 or save 1,000. Your first deposit would be 1,000. So we're going to build a foundation. We're going to focus on SPY. We're also going to look at SPX, but later on past 1,000, more towards 2,000. So if we're looking over here, we can go to the SPY option chain and we can look for 1 to 5 days to expiration, and we can sell credit spreads. So you don't need much, 300-400 in buying power, and you can profit 30 to 50 on puts and 60 to 80 on calls. That's profit from a credit. And most of the time you keep about 70-80%. So if we look at this simple little strategy, 1 to 5 DTE credit spreads on SPY, and then with a eventually working your way to SPX, where everything increases a little bit. Let's actually do this. So working your way to SPX, where you're looking about 100 to 110 on puts, and about 130 to 140 calls. These are the two main strategies you're going to use when you have a small account. All right. So what is a credit spread? It's very simple. You're just going to have an area where you're going to have price All right, this is a general idea of price. And you're going to say, okay, say this is Monday, Tuesday, and you think on Wednesday that we've basically put in the high of the week, and we want to say, I think that the high is in, I'm going to lock it in. So anywhere in this area right here at the highs or even coming away from the highs, I would look to sell a call spread above price. So what that's doing is what that's doing is saying that if price does not break this line and stays lower, I'm going to keep the credit of anywhere from 30 with the SPY. I'm going to keep the credit from 30 to 100. And we're going to run anything from 1 to 3 DTE, sometimes 5 DTE on Mondays if we have a clear view of what's going on. Otherwise, Monday's basically a guess. So we're going to have 1 to 3 DTE call credit spreads for 30 starting out, and then we're going to work our way to $100, and you're going to do 2 or 3 of these a week. 1 to 3 a week. All right. So once you get up to SPX, that could be $300 a week. That's an easy way to just consistently try to get some credit by doing call credit spreads at the high of the week, and conversely put credit spreads at the lows of the week. These are generally a little bit cheaper because, you know, they say puts are schmutz and calls create walls. So the puts are going to go for just a little bit less, so like 20 to 80 dollars in credit. So 20 when you're first starting out, and then 80 when you start to move up to the SPX. So that's a general idea of what the first foundation of phase one. You're just going to be selling credit spreads. You're just going to be selling, and that's it. There's no, it's either a put credit spread or a call credit spread. That's it. When we get into phase two, we're going to see that we're going to maintain this entire strategy, but we're going to add in one little addition to our trading. And what we're going to add in, it's called, well, it's not called anything. It's just directional micro ES futures options hedging / speculation. All we're doing here is once we sell these spreads like this, if we know the market's heading down, we can add in a long put, or if we think it's going down, we can, or up, we can do a long call. And we can add some convexity to our portfolio, which just means that as price gets through our, as price comes through our put, so say price is starting up here, the second price reaches our put, it becomes at the money, and once it's at the money, the gamma accelerates, and once that happens, the options pricing is exponential, and it's not so much linear like futures. Futures are $50 a tick, $50, you know, a point, $50 a point. What was it, $12.50 a tick, and NASDAQ $20 a point. So ES 50 a point, NASDAQ is $1 a point, And no matter what, it goes up 100, you're making, $5 grand. But if you go up 100 points in options with convexity, you're going to accelerate those gains. So it's not going to have a pretty linear model for profit. So with options, we get to put a container on the market and say, this is my call credit spread. Market's not going above here. This is my put credit spread. The market's not going below here. I'm putting a container on the market and I'm going to trade in between. I'm going to either hedge a call credit spread. If price is going against me, I'm going to buy micro ES long calls, or I'm going to buy the actual futures product. So these are the two ways you can scale your account from 1K to about 5K, doing the convexity, adding the convexity in here. So now the last model that I'm going to introduce for this piece is going to be adding multiple positions across multiple strikes. So what you're going to do is, if we take a look at the brokerage account, if we have SPX and we're really kind of just sitting in this zone right here, this 1 to 5 DTE zone, this is where we're really kind of doing our weekly income. We can start to look at 21 DTE option expiration days, where 40 days out, 30 days out, 7 days out for this month's option expiration. So we can start looking at these strike prices and layering in the same exact credit trades. But the beauty is we're going to do all of this by delta. So when we're selling credit, we're going to look for on the short strike, because when you sell credit, you're going to have a short strike and you're going to have a long strike, right? So for calls, it's going to be up here, top like this, and then vice versa. So this is what it's going to look like when you're selling your credit spreads. So now what we're going to do is, if this is what the market looks like, this is going to be what I like to do is a 16 delta. Short strike, which I'll show you what that is later on. 16 delta on each side, on each short strike. So if this is what, let me see something. If this is 3 DTE, then your 21 and your 30 DTE are going to be up here and up and down here for your short strikes, right? And then you're going to have the 16 delta here. You're going to have your long strike here for like a 21 DTE. So you're going to have this down here for the puts. So if that was 3 DTE, which is inside of here, then you get 21 DTE, which is all the way out here. So if price is bouncing around inside of here, we can go farther out and get the same 16 delta on each short strike, but the price is higher and the price is lower. So now I get more room of cushion if I layer in a 3, a 7, a 21, a 45, a 90. I can layer in these spreads, these credit spreads. So that's the third part that I call acceleration. The acceleration is going to be when all your strategies are coming together, and you're going to start layering in the DTEs and giving them multiple chances to capitalize on the implied volatility, to capitalize on the deltas being at different strikes. And that's what's going to get you to 5 to 10K. Now, if you come up on a stock that you like, you can always add the wheel strategy into it, which is selling a cash secured put, getting a sign, and then rotating covered calls on that, which is another good one, but it only works if you have a stock that has a low value, because you can't really do the wheel on with less than like $50,000 properly to get assigned. You could do a poor man's covered call, which is really just a 70 delta long call, and a 6 no 30 16 20 to 30 delta short call. This one could be a leap, and this one could be like a 21 GT. And then you can just keep this train running over and over again if you want. This'll pay out. These are great plays, but it ties up a little bit of capital. It's like $3,000 for one AMD contract, 6 months out. Apple, Microsoft's probably more. So these are the strategies that you just have on repeat over and over and over and over again. And every week you should have an 80% win rate, because that 16 delta I was telling you about is actually used as a probability that price will touch that price and that level. So these are the simplest, fastest way I think you can get from 1K to 10K, utilizing credit spreads, hedging with micro ES futures, and then once you get enough capital, you can open up multiple credit spreads within different DTEs and capitalize on more book value. So if you found this valuable, like, subscribe. Thank you guys, appreciate it. And I'll do another video of a 10K to 25, and then a 20 to 100, 100 to a million. Yeah. Thanks, guys.